Welcome to this webinar that I get to co-host with NARRATE Holdings, where we're going to go over a really cool mini fund for three Colorado development opportunities. 1000 South Logan, 428 South Nevada, and then 3981 North Weber. So these are all three projects in various stages of going underway. And we'll go through all the details about the projects individually and also how the mini fund or the 3-pack is working as well. Before getting the details, I have to give you the standard disclaimer here. Now, we are not your lawyer. We're not your financial advisor. So always go out there and make sure you connect with and talk with your professional team. And all the numbers we're sharing, this is company sourced information with the forward-looking statements. So this is data that we've researched and that we are sharing as well. But of course, go out there and do your own due diligence. And we have 3 deals to cover, and we'll share all the numbers and all the details after as well. So you get into the nitty gritty and understand everything to make sure you're making the best investment for you, your family, and your portfolio. But moving on to the fun stuff now for the agenda. We will do a quick executive summary on the deals and how the 3-pack fund is working. Then we'll talk about the official introduction to NARRATE Holdings. And then we'll do a deep dive into each project here. And then we'll follow up with just some investment next steps and then some questions and answers as well. And also we'll throw out some dates for some follow-up calls. And we also have some tentative dates going out there, actually do some either site visits or do some meet and greets at the NARRATE office in Denver. All right, so moving on to the summary here. NARRATE, the sponsor, which is founded by Adam Fenton. Good afternoon, Adam. Hey, I realized I didn't get to introduce you. How are you doing?
I am great. I'm great. So thanks for again here at the table. So thanks for having us. Appreciate it.
Yeah, I'm really excited here. So I'll run through the executive summary, and of course you chime in here and you get into all the details. And I'll be monitoring questions throughout this whole webinar. So NARRATE is a sponsor. They're the developer and GP on this project. And then Property Llama Capital, we're helping them to do some marketing and then bring some of our investors into these opportunities as well. So the 3 projects we'll be talking about is Weber, which is really answering the need for affordable housing to like the missing middle in northern Colorado Springs with an estimated about 8% cash flow. And then Canopē, which is in downtown Colorado Springs, is going to be a mixed-use retail and multifamily development with up to a 10% cash flow. And then 1000 South Logan Street, which is a Class A plus bespoke multifamily development in Denver's amazing Wash Park neighborhood with about a 9% average cash flow. Now, overall on this fund, we're estimating about a combined 15% IRR. Now, I know sometimes people say, hey, that seems a little bit lower on the multifamily side. Well, understand this is going to be more between like a 6 to 10 year hold. And we're expecting equity multiples in like the high 2 to low 3 range, kind of like 2.7 to 3.2 range. So it's very attractive on there.
And I would say also the other thing, Chris, is when we're estimating the 15 IRR roughly, that's on a 10-year hold, right? So if you run that shorter, your IRR is going to be higher, your multiple is probably going to be a little bit lower. So less cash flow, but shorter time frame, so your IRR is going to jump. So I think we have a range on the forecasted cash on cash and multiples. But all the numbers you're seeing in here it's based off of a 10-year.
Yeah. And as you guys can see too, the deals all should be about the 8 to 10% cash flow. So the mini fund will kind of be a blended of those as well. So incredibly strong cash flow as these projects get stabilized. Now this is a 506C, so it's open to accredited investors only with a minimum investment of $50,000. And then Adam, other GPs at NARRATE, and then myself on the Property Llama team, we're all co-investing in the deal as well.
Yep, that's correct. So I think every deal is going to be a little bit different in size, but you are usually at minimum 10% co-invest, anywhere up to 15 to 20%. So it really depends on how the capital stack kind of lays out at the end of the day. But we're already pretty heavily invested in these projects with our own capital, but we'll continue to put more capital in and leave it in for the long term.
Yeah, and that's what I would like to hear. Like, normal range is like 2 to 10% co-invest, and you guys are usually on the higher end of
We
it,
are.
which
Yep.
hey, shows you guys have the money to help fund the project, but also you put your money where your mouth
Yep.
is because you
Yep.
believe in the
Yep.
project.
Yep. We wouldn't ask anyone to invest in something we would not be willing to do ourselves.
And then looking for the capital call to be in by Friday, November 22nd, so just before Thanksgiving. Now, there is different timing on here. So if you have an extenuating circumstance with a closing property or an IRA rollover, we do have some wiggle room for a couple investors in there. But we're looking to have all the capital in, or majority capital in, by that week before Thanksgiving. All right, so Adam, we talk a
Yep.
lot about this. I always like to hear from you. Why do you love these deals?
I think these are deals that serve their own individual niches in within that individual submarket in a sense, right? So on past podcasts we've talked about location, location, location. So that's something we're extremely focused on. Right, when we look at South Logan, I call it an A++. This is an A++ location in an area where there's huge barriers to entry. So that's why I love South Logan. The Canopē project, downtown Colorado Springs, and even though the market has seen some supply over the last couple of years, we believe in the long-term growth trajectory down there. Why we're looking at it on a 10-year basis. We feel that market is continued and going to be poised for extremely strong growth in the long term, especially with a lot of things that the city is doing to attract residents, to attract new companies. We just feel that that is a market that has a long way to continue to grow. And then the Weber deal is very interesting too. So that one, it's up by UCCS, so that's University of Colorado Springs. And this one's very interesting because I think we're actually doing something to help solve, this missing middle. It's not affordable housing. I try not to call it affordable because it's really, we're trying to target that 80 to 120% AMI. Right? There's not a lot of programs out there that you can utilize subsidies on to provide this type of housing, but they also can't afford these huge high rents that a lot of developers are charging in order to make their projects pencil and move forward. So we were able to get a great buy on the land. We've got a great partner on that project as well, that is local to Colorado Springs. So we just feel it is being able to take the knowledge and skill set that we have, buy the land at a really good price, and really have design something here that we think helps put a little teeny tiny dent in the overall issue that most large cities are facing right now in affordability.
I love it. And kind of me, I'm just kind of wearing my LP hat now. I always love the diversification.
Yep.
I get one check exposed to 3 properties, and they're geographically diverse.
Yep.
I'm very bullish on Denver and Colorado Springs over the next 5, 10, 15 years. And then you're hitting some different, like you said, different resident classes as well, which is always nice. Now, something else, again, that I like about all 3 of these projects, you guys already own.
Yep.
They're entitled, and they're already in various stages of pre-development.
Yep.
And so it allows us as investors have much better visibility on what's going.
Right.
Hey, so lots of going well. Sometimes things are adjusted.
Yep.
So talk about that.
Yeah, a little bit about that. A lot of times when we initially raise money to take land down, we're doing it and we really don't know what we can build at the end of the day. It's just the competitive nature of the marketplace. You get a little massing study done. You generally know, but you've spoken to the city briefly, but you really don't know until you get into the nuts and bolts of it. So all of these projects are at different stages of entitlement. As example, Weber, but that's 100% CDs at this point in time. So we're through, and we have an approved site development.
What?
100% through CDs, through our construction drawings. I mean, that thing is permit ready. Now we're going through some other things which we'll get into the deal specific that has delayed. It's not really a delay. It's just we think it makes the project better. So we're going to wait to break ground on the project. And then the other 2 projects are also in various different stages. So I think, coming in at this point in the project, right, it's not a hope and a dream at this point in time. It's a real project with real numbers, and a real path to, getting to vertical development. So in my opinion, a lot of that risk is taken off the table as compared to, an early investor on initial land takedown.
Yeah. And so the last item on here is just kind of like, looking at the current economic landscape, these ground up development deals. You always say, hey, you know what you get because you're building it,
Yep.
which is different than value add, which is, hey, sometimes a surprise once you open up the
Yep.
drywall on there.
Yep.
So I know you feel very strongly that these deals can be very strong and on like a risk adjusted basis
Yeah.
should perform very favorably compared to a lot of value add deals.
Yeah, I think so. I think though especially in today's market, we're seeing value add deals at 4 to 6% cash on cash returns. That doesn't excite us. We're not doing those type of deals, but that's where you're starting to see deals get done just with where your interest rates are currently and the debt market. So, I look at this as an opportunity to invest in, really great returns, but you have a brand new building. And we try, with development, there are certain things you can't control, right? We don't control what interest rates are. We don't control exactly what the rent is in the marketplace and those type of things, but we do control the sites we buy. We control the type of project we build on it. We control how we put the capital stack together. So once we're out of the ground, it's really just execution risk at that point in time. And I think we've done enough of these now at this point in time where we have a really good handle and processes and procedures on the backside to, I think, limit that risk.
Great. All right. So moving on to a little bit of background about NARRATE. I know some people on here know you, some people invested in deals, and some don't. But who is NARRATE, Adam, or what is NARRATE?
Yeah. NARRATE, we're ever evolving. Feels like on a daily basis. But so NARRATE, we're based out of Denver, Colorado. We're a private equity firm essentially. It's myself and my partner Zach Kobilka. Our partners within the company. We essentially kind of 3 different lines that we invest upon. So 1 is going to be ground up development, 2 is going to be value add, and then we've got a 3rd component to our business where we actually invest in operating businesses that are not even real estate related. So completely different business model with that. And it's really diversification for us, diversification to cash flow, and trying to provide something to our investors at the end of the day that they might not get somewhere else. We've been around, NARRATE's been around since 2019. A little over a year ago, Zach and I merged our companies together to create what is now NARRATE Holdings. So we're not a huge team. We're pretty small. We're nimble. We're entrepreneurial, but we also come from corporate backgrounds. So that's kind of where I cut my teeth. So I think we bring that the right amount of processes and procedures and risk management, but we also don't get bogged down in it. So that's all we do, and that's all we care about, right? At the end of the day, we're deal makers, and we like to make deals happen. But you have to keep it within the rails as well.
Yeah.
So I think we're a little unique in that sense where I would say we're opportunistic, entrepreneurial organization. But with the time that Zach and I have been in real estate, and he's been in the venture side for since 2008, and I've been doing real estate since 2006. So I think with that we bring a pretty strong background with different companies. So we've been able to bring over the good stuff and incorporate that within NARRATE, and then the bad stuff that we think bogs companies down, we leave behind. And the minute we become corporate, I think Zach and I will both be out. So, so that's kind of our firm. I think we're a firm of about 9 or 10 people now. So we all A+ players, and we continue to work hard every day and continue to grow as we move forward here and take on more responsibility and more deals.
Yep. But not only do you guys have an impressive team and impressive background, but you also have some track record already of some stuff that not only done previously in your previous corporate lives, but NARRATE as hell.
Yep.
Could you just kind of give us a quick overview about some of these properties where, hey, you've built it and then you rent it out and stabilized?
Yep. Yeah. So these are 3. What you see on the screen right now are three assets that we've built. We've built and essentially stabilized and are now holding for cash flow. So the Aston, that was one of our first projects we started on. It's a project that's in Platt Park, right on South Pearl Street, 73 units, over 5,000 feet of retail. This has been stabilized now for coming up on a year. So we got through our lease up very quick. We're outperforming the marketplace by about 18% on our rents here. And we can get into that. Maybe we've even gotten into it in other podcasts, but a very special boutique, unique asset. And honestly has helped us come up with our business plan for our 1000 South Logan property. It's not too far, and some of the things we saw here were unexpected. So we were able to take those and had an opportunity to buy another site and really execute on what we learned.
Great.
We got 3354 Larimer. So that one's the littlest project we've ever done, and probably ever will do, because it's the hardest one we've ever done, believe it or not. So it's down in Rhino. It's a great little project, mid-block. So it's 23 units, over 7,000 feet of retail, master lease to Sonder, which is kind of like a hybrid between an Airbnb and a hotel. Yeah. And then the Caraway is another one in Platt Park that we did in conjunction with Confluent Development. It's 42 units, no retail here, stabilized asset that's performing well to this day.
Yeah, I mean, so all beautiful assets, and we can happy to share the addresses. Go drive by them at some point too. So let's move on and jump into deals.
Yep.
And this is where we're going to spend the bulk of the presentation. So the first project we'll talk about is 1000 South Logan. And I'm going to switch between some slide decks here. So give me a second to get that going, the right slide deck. And then we're going to share all else afterwards as well, because you can see there's a lot of meat in here.
There's going to be a lot of info in
but we will share everyone so everyone can read it on their own time and, of course, do their own due diligence. All right. So what's the rundown on 1000 South Logan?
Yep. So
Adam?
1000 South Logan. It is about 65 unit project. Kind of fluctuates a little bit, but located in Wash Park. Great location, very close to our Platt Park project. And as I mentioned previously, when we built Aston, it was very interesting. Our larger one bedrooms there, they were the first ones to go and went for the highest rents per square foot in the building, which is a little bit, against what you typically hear. Usually you hear smaller units, higher per square foot. That's not the case at all. If you build the right asset and have it in a qualitative, very, very high quality. So that's what we saw at our Aston project. So we had the opportunity to buy this project a little less than a year ago. So we bought it last December. And really the business plan here is large one bedrooms. We've got some smaller units here and there, but really the bulk of the units here are larger one bedrooms. And when I say larger, I'm talking 825 to 925 square feet. And at our Aston project, those went for $3.50 a square foot, which is kind of crazy when you extrapolate that math. But what we found is if you have a really killer location, you build a high quality, your layouts are great, and you have the right amount of amenities, and the neighborhood is your amenity, then people want to be there and live in these smaller projects and really get that great sense of community and proud to live where they are. Yeah. So that's really what was behind this. This was a piece of land that we had offered on almost 2 years prior, and just couldn't make the numbers make sense. So we kind of sat and waited, and ultimately came back around to us at a price that we thought was a fair deal, and bought it last December and have been going through the entitlement process right now. We're getting great feedback from the city. We did take a slight detour that was unexpected, in that we're going through a rezoning, which we can talk about in a Q&A or something. It's kind of a long story and why we decided to rezone it, because we're not necessarily guys who go and buy stuff and rezone something to make it work. But this allowed for a lot of, a rezoning allows for a lot of efficiencies on the site, not necessarily more units, not a bigger building, just more efficiencies at the end of the day. So we've been spending a lot of time recently working with the city and the neighborhood to gain their support, which we're getting, and we'll have this rezoning done in a little over another month, and back off to the races from an entitlement perspective here.
Great. And just while you're talking, I've been flipping through a couple of slides on here so we can see the pictures, location, and just what a beautiful site.
Yep. Yeah.
and the renderings you have on there.
Yeah, and you can see Aston and Caraway off in the view right over there.
Here in the upper right.
Yep, on the upper right. So we have experience building in these tight, small, high barrier neighborhoods. And we can talk, I think one question that might come up is, what about the highway? We know how to deal with the highway. We can turn it into a positive versus a negative if done the right way.
And the fact that these two are performing is,
I think is a testament to that. Yep.
And so two things before we get the numbers here that I really like about this is location.
Yep.
So first off, it's in not downtown Denver.
Yep.
Or in Rhino, where there's 1,000 cranes right now, but it's in Wash Park, which is one of the hottest neighborhoods in Denver and a very highly desirable.
Yep.
And second is you bought this as a covered land play.
Yep, it is a covered land play.
Which for what that means is there's existing, I think, 20 some units building on there.
20 units on site. Building was built in the 1940s. There's just a higher and better use for the site. But at the end of the day, we still bought the existing property at a 5 cap.
Yeah.
So where 3 years ago, this thing would have sold to an existing value add guy at probably a 4.5 or 4. So to buy at a 5 cap on a covered land play, we felt like was a pretty good deal, just in case that development didn't make sense or we couldn't make it work. There was obviously the returns aren't going to be as high in a covered land play because that's not ultimately the highest and best use, but it is something that if it doesn't go according to plan, there is a fallback there where it's not, hey, we're just out. It's hey, we still are going to make money.
Yeah, and actually, before you guys bought it with one of our value add funds from sponsors, this is one of the ones that we had looked at, and the numbers didn't work out, but it makes sense for development.
Yep.
And the great thing is, I think pretty much like the cash flow pretty much covers a good chunk of the expenses that you guys are incurring right now, right?
Oh yeah. It's covering all of our expenses. Plus we did put some acquisition debt on this at 50%. So we're covering debt service. We're covering all our expenses. And as a developer, like, you couldn't ask for anything more than that.
And so on the screen, won't go through this, but this is the cover land play with the existing building on there and a picture of it. And then we'll kind of talk about what the plans are. I don't know if there's a certain slide you want me to go to for the timeline, or
I think we can go through here. Just really talk about, you can kind of see all of our numbers here. We break it down on the right side, and we're assuming we can assuming 65% debt here,
which I like. It's conservative.
That is conservative, and I think that's something we can pretty easily do in today's market. You see the site acquisition cost there at $4.1 million. Hard costs are right around that $21 million number, and I can attest we just got two updated bids in earlier this week, where one is a little less than that. So that doesn't happen very often in development. Usually you hope and you pray.
Some wood,
right? Let's knock. Usually your numbers go in the wrong direction, then we're VEing. So this feels pretty good and is trending in definitely the right direction here.
And so, of course, we'll show, so if we can go through the whole numbers, but a total project cost of about $32 million, right?
Yep.
All right. And then, oops. Sorry.
Yeah. So these are your returns. So project level, you're at a 2.8 equity multiple. You're looking at on a 15-year or it's on a 10-year hold. You're looking at about 15.1 IRR, which I think when you look at it on a 10-year basis, that's pretty strong.
Oh yeah.
And then your cash on cash are strong here, and on this one we'll assume more traditional construction loan with then a takeout of permanent financing once the project stabilized. Most likely 36 to 48 months out is typically kind of when we look at that to make sure that we're operating at its full capacity.
And one of the things I like about this, we'll talk about numbers and follow up like Q&A sessions, but this is like a 6 to 10 year hold between all three projects.
Yep.
It's always like when I've been oh, go ahead.
I was just going to say on that too, just to clarify too, each project doesn't necessarily have to be the same hold period either, right? So if we see a great opportunity to sell 1000 South Logan in year 7, but we think it makes sense to hold the other two longer, with the way we're going to set this up, we have the ability to do that, right? So that allows us still flexibility to, I think, maximize our returns for our investors.
Yeah, which I love. And And because I've been in deals, like, oh, great, get a high IR, get your money back in 2 years. Like, well, cool, I got my money back, but take the money back for me again.
Now what do I do with it?
And I like the longer term hold because it kind of takes out that the guesswork. And if you ever do like a long term IRR forecasting, like, hey, if you got your money for 6 months in between deals in a bank account, that knocks off the IRR quite a bit as well.
It does. And I think the other thing I would say, Chris, is if we decide that, hey, we think the hold period for 1000 South Logan is better at 4 years versus 7 or 10, and we do something that's outside the business plan, we'll, to not leave you in the situation that you found yourself in, where it's like, okay, great returns, but now I have this money. Now what do I do with it? We always like to have something else for those investors to invest back into that would be in similar, risk profile. I would say same return profile that we would do here. So that's one thing we really try to think hard about.
Awesome. And we'll go through. I don't know if you want to talk about the project milestone schedule for a second.
This is a little, we're about a couple months behind this at this point in time, and part of that is due to the rezoning process, where the city made us hold up a little bit while we really started the beginning point of that. So we're essentially ready to dive back in and move full speed ahead here at this point in time. We have not kicked off the design development yet. You can see that's supposed to be completed in December 2024. So I'd say we're about a month to 2 months behind this schedule. I apologize, we didn't update it before we put it in here, but it's a little bit of a moving target, especially within Denver. And some of the I want to say it in a nice way, but they're not very reliable. Let's say that.
I see some questions in here. I just noticed people asking, how do we get the deck? We're going to put all of this. We'll put the recording. We'll put all 3 decks in a data room. And then whenever we have follow-up information or future phone calls, and as we kind of get all the final legal stuff and combined financial model, it'll all be in one space. So we'll send all out either today or a lot of it probably this weekend as well. So we'll send all to you to your inbox. We'll consolidate everything for you guys. And then, do you want to go through pro forma or just?
I can barely even read it. But,
well, this just shows that we'll let you guys do it. But
it's a 10-year, essentially a 10-year cash flow here of how we expect this to return. What does it look like from a revenue and expenses? This is a straight, this is just a straight multifamily deal. There is no retail associated with it. So you can kind of see what our assumptions are in here and how we get to the returns that we're ultimately getting to.
Yeah. So we'll again share that so you guys can dig through it. And sorry about that. Apparently when I zoom in, it makes it difficult to go back out.
Yeah. So you can see, I don't think we, just to do the interest of time.
Yeah.
I think,
rent studies.
We've got rent studies. We've got expenses. We have sales. We have sale comps. We have all those things that are a part of this deck that, we use in order to, validate what our numbers and our assumptions are here. And we'll, what I found is you usually miss on all of them. Hopefully you miss on the good side versus the bad side.
Exactly.
But yeah, it's, I think, for us, we've got a lot of experience within this type of product, in this marketplace. So, I feel like we might be the utmost experts of, boutique development within this small micro submarket over here, Platt Park and Wash Park.
All right. So we will move on from the 1000 South Logan slide deck. Again, we'll share it so everyone go through and, go through their own thorough due diligence. And we'll move over to Canopē, which is in downtown Colorado Springs.
This is downtown Colorado Springs.
So I absolutely love Colorado Springs. I don't know if you, spend a day, go drive through downtown Denver, then go drive through downtown Colorado Springs. They're on very different trajectories right now. And the investments that Colorado Springs is making, the soccer stadium they're putting in, the growth down there, like it is amazing.
Yeah. It's a market that we started following really closely in 2021. When we were were looking for markets outside of Denver to continue growing our development platform, and we were looking at out of state even, and we started digging into Colorado Springs, and quickly got very interested based upon what had happened over the last handful of years, what the projections were moving forward, the amount of people that are moving down there. I read a report, it's probably 6 months old at this point, but it's 42.5% of the renters who are leaving the Denver MSA are going to Colorado Springs.
Oh, that many.
That many, and I think at the end of the day, I think it used to originally, it was probably for a cost of living thing. I think, I'm not going to sugarcoat it. Colorado Springs has gotten more expensive to live down there recently, but I think it's for a lot of people, it's just a quality of life.
Yeah.
And quite frankly, their city administration is blowing Denver out of the water. With what the things they're doing to, I think, be pro-growth. I think Denver is doing the opposite. I think they're doing everything to stymie growth. They're doing everything they can down there for pro-growth. And I think just the amount of positive, and I'm not crapping on Denver either. Like, Denver is an awesome city, and it's going to, just the merits of what Denver has, it's going to continue to perform strongly. But Colorado Springs is coming up on their heels pretty quick here with the companies, the companies that they continue to attract from an employment perspective is something that's really, really interesting. That I feel like every other week you're opening the paper and 600 new jobs that pay $175,000 a year, right? It's really qualitative, and the city is very, very responsive, to developers, and they, they're pro development. They're like, how can we help you? How can we help you be successful? Which is a pretty cool feeling, and something we want to be a part of.
Great. And again, we'll share the stack, and we're just going to kind of hit on the highlights on here. Then we're going to go through and read it themselves. But you can see here's a great location map. Where is, I'm turned around on here for downtown Colorado Springs on here, but it's you guys were pretty close to the soccer stadium, right?
Yeah, Widener Field. Right.
Yes.
There. Yep. So we're literally the other way.
Oh, there we go.
There you go. Yeah. So we're literally 3 blocks from Widener Field.
Yeah.
So as you're mentioning, what the city has done, just in investing in infrastructure down here, I think is huge. Just they continue to put money down here. You're starting to see the bigger developers come down here as well, right? Greystar has a very big presence down here. Widener Group, they're the ones they're building units around the soccer stadium now. Yeah. So it's just we're the new Olympic Museum. If you haven't been, it's incredible.
That's on my list.
It's like a piece of art, and it's just the building itself. So just with everything going on down here, we just become big believers. The south end of downtown is where you're seeing all of the new development come, and that's where this sits, is right in the smack dab center of that, at the corner of Cimarron and South Nevada. And just an opportunity to buy land down here at, a really good basis. We had an opportunity to buy this land a couple of years ago, and we've gone through a couple different design iterations. We were able to make the project a little bit larger than we had originally planned by buying some additional land to us next door. And, just believe that there is, huge trajectory down here. And, the other benefit is this one sits in an opportunity zone as well. So we can accommodate opportunity zone investments into this project. And we won't get into the details of what opportunity zones are, but folks might have some opportunity zone money that's sitting there that they don't even know.
Yes. Or if you're having a hard time placing your 1031 money and not real happy with it, definitely put the qualified opportunities on your radar. And we'll talk more about that in future webinars. And so I had the screen wasn't sharing for a moment. You were just kind of missing some pretty pictures, but we'll share the deck, and then walk us through a high level, just kind of like, total cost and everything like that.
Yeah. So total cost on the project is about 72.4 million. So we're not talking a small project here. Our site acquisition is 16,000 a unit. That's very strong. Usually, in Denver, I would say Denver, other major large metros, you're probably starting about 30,000 a door.
So say that again. So your site acquisition, is that like your total site cost divided by the number of doors you're expecting to build?
Yep, number of doors. Yep.
Okay, so
Yep.
you're about half of what you typically are for major metros.
Yep. Yeah, I think you're about half of that. We got a really good land buy down here. We bought this at $82.50 a square foot, which is pretty strong considering you have unlimited height and zoning down here. We could technically build 1,000 stories here if we wanted, but we're built. This is a 7-story project. The other thing we did, Chris, is we moved all of our parking, out of the ground, so it's all surface. It's all parking above grade.
Oh, nice.
That saves you about $20,000 a unit, I would say. $20,000 a spot. So we're looking at 7 stories here. And we cut it off at 7 stories because once you go above that, you get into high rise designation. Even though it's not technically a high rise, once you get to certain heights, there are certain things that you have to do that add cost to the project. From most of it's from a evacuation and fire protection standpoint.
Okay.
So we just and we like, generally speaking, we like smaller deals. We just think in order to create a sense of community, things like that, even though it is 183 units, it's getting up there a little bit, but we didn't want to go much bigger, even though we could have. And to be honest with you, the more units you build, the better your economics look, because you get the economies of scale. You have fixed costs that you have more units and more real estate to spread it across. But we just felt like this was exactly the right project for this location.
Great. And then again, we'll share all this for the numbers. And again, we got the 10-year pro forma, which we'll go through, but let's do a quick, cash flow.
Yep.
You can see it grows everywhere.
Yeah.
Every year.
Every year it grows. So if you go back, I think one thing I will mention is you see a pretty big jump. And you see a jump that's a refinance year. Okay. So we're pulling equity, we're returning equity back to investors. So essentially, even though your ultimate cash flow doesn't change a lot, from an NOI on the property perspective, you're returning cash to investors, so your denominator gets bigger, and that you're spreading it across.
So in year 4 or 5 is the estimated refinance.
Yep, and that's, I think, flexible, right? If we can do it sooner, it's one thing.
It always depends, right?
It always just depends, right? But what our strategy typically is on these assets where we know we're planning to hold them longer term. We'll go where we're using traditional construction debt. We'll talk about Weber next, which that one's a little bit different. But we're looking to refinance out of the construction loan at that point in time into a permanent loan. Now we will look at the construction to perm loan programs. We actually talked about them on one of the other podcasts. Those don't exist really right now. So those will come back at some point in time, I'm sure, but that's not really a financing a financing option for us right now. But I just want to be clear, that's why you kind of see that jump from year 1 to or 1 year to the next year.
Wonderful. And then let's see. I mean, here are all the rent comps for everyone to go out there and view. And I dug in this a while ago. I was really impressed with the rents down there in Colorado.
The rents, and
much stronger than I was expecting.
Much stronger than we were expecting as well. And there's a huge pent up demand down there because nothing was built for quite a while, and no one really wanted to be the first one to go. Once the first one went, the first, what I would say, real major project, rents went well over $3 a square foot. They leased it up in 3 months. I've actually never even seen a unit in the building because every time I go, it's 100% occupied.
That's a good sign.
Yeah. Now there are rents coming, new projects coming down here. So you're going to see a little bit of that downward pressure on rents. That's how it always goes, right? When you start introducing supply into a marketplace. But I think, we try not, we're aware of what's going on, at the present moment, but we also like to look out much further than, the next, 12 months, 24 months. Okay, if this is a long-term hold for us, you have to make sure it performs in the short term, but we're really looking at that long-term value creation.
Yeah. And kind of, not speaking on this too, but kind of like the macro across all the markets on here is, if you look at, multifamily deliverables in general, in Colorado and nationwide, next 12 to 18 months, there's a healthy amount coming online, still very strong demand. But after that supply comes online, there's nothing behind it.
There's nothing behind it. And that's why we're continuing to move forward with the entitlements of these projects.
Yeah.
Is we think there's going to be a gap in there of 12 to 18 months where all the big guys, they're like sheep, right? They follow what the other guy does and the other guy does, and none of those guys are doing anything right now. They've laid off a lot of their staff, right? We're just going to keep one guy in the office. We're going to keep the office open. Maybe we're finishing out if we have things under construction, but we're just set up a lot different. We're not institutional like that. So we can be opportunistic, and when we see people doing one thing and we think there's a good business case to be made for doing something different, we're going to do it.
And I was at a conference. It was this really smart analyst, I think from Real Pages, or I forget one of those real companies, but he does a lot of institutional data crunching. And he was basically saying, hey, you got inventory coming next 12 to 18 months. We'll have some slight downward pressure on rents. But he's like, look, when we took a step back and looked at all the data in the long run, he's like, look, sometimes these developers and buildings say, they get the short term, just the timing a little bit off. But when you look at the long term, these markets over like a 5, 10, 15-year time horizon, they absolutely crush in terms of like rent growth and absorption. And he's like, hey, next year or so, stomach some soft rents. In the long run, everything's looking for a very, very favorable and strong market.
That's he's probably got a lot more analytics behind his analysis.
He's smarter than us, right?
He's smarter than us, but high level, that's what we're looking as well. And that's really just understanding what's going on in the marketplace, and look, not that we definitely analyze numbers and things, but that's the exact strategy that we're looking at.
And again, so go through these rent comps, and you can see it's laid out very favorably. We get the sales comps on here, the land comparables as well for some other similar projects. And then let's put a second here on the milestone schedule. What's the kind of the big picture on here?
Let's see, when do I have it starting construction here? You know what? This one's actually this one's not too far off. I think this is a late summer start. Just understand where we are right now. We've had our first round of submissions with the city. Nothing major came back at all. So we feel really strong about this project, and this is one, we'll start getting out to banks, at the beginning of next year. Knowing that we're 7-8 months out, we like to continue with our design, bake our numbers a little bit more before we go out to banks and things. But I would say this is definitely a late summer start for us next year.
Great. So we will wrap this up, I think, and we'll share all this information. Move over to Weber in Northern Colorado Springs on here. But one thing I actually want to make sure you highlight on here, because you allude to it very quickly at the beginning. Most of the time, hey, you raise money when you acquire the site, and then you spend, your time getting everything ready, and then you raise most of the money once it's ready to go vertical to build up. Well, this is a little bit in between on here. And there is some really favorable conditions, economics that investors will get into, kind of with this like in between stage. Can you talk about that from a high level?
Yeah. So one thing we like to do is if someone comes in and invests in the land with us, that's probably just saying what it is. That's probably the riskiest part of the project, right? You're spending money, but you've really produced no building, right? You have an expensive stack of papers, essentially, drawings at the end of the day. So what we like to, so there's an opportunity. All investors will have an opportunity once we get to the point where this thing goes vertical with construction to either at that point in time say, hey, this is something that I love, I want to be a part of it. You could potentially even put in more money, or you might say, hey, we want to do something different with our money at this point in time. There is an opportunity to get out as well. So if an investor comes in, let's say we close this late November, we go along and life circumstances change, and next August they decide they don't want to go vertical with the development, they don't have to. So you have the opportunity to get out of these investments before the actual construction starts. And, I think that's a lot different than a lot of developers do. A lot of times, if you come in and you commit day one, you're kind of committed to the whole term. And that could be, 7 to 10 years potentially. And, we could talk about it as well, but there might be another opportunity to get out at a refinance or something once the project's built. So I guess where I'm going with that, 10 years some people like that long-term commitment because they know where their money's at and what it's doing and the project it's in. Other people like a lot more flexibility and things. So we kind of
Or life happens sometimes too.
we try to make it so that both we can kind of accommodate both types of investment strategies.
And the other thing you've told me is that with this, a lot of times people come on the earlier side, they get the little slightly favorable economics once it goes vertical.
A little slightly better economics as well. So what you'd be treated more as a GP investor rather than an LP investor. And the big difference between that, our money that we invest in a deal is treated as GP as well. So what I mean by that is if you elect to take part in the vertical development, you're not going to have your dollars are not going to be ran through a promote essentially. So whatever your deal level returns are the returns that you as the investor are going to get. And in some deals that could be 200 to 300 basis points potentially.
Yeah.
In here we've put promotes in here. We don't know what our promotes are going to be at the end of the day. That's dependent on who we bring in from an LP capital side at the end of the day. Which we'll get in, we'll start those conversations about the same time that we'll start the conversations with the banks. And from an LP perspective, it's a fairly, this will be a fairly large check on this project. But yeah, that's one thing we like to do as a way of, really saying thank you, right? Thanks for, being a partner of ours, and believing in our vision early on in the process. And there should be some sort of, I guess, reward for that at the end of the day. And that's how we think we can best accommodate investors for that.
I'm happy with a better return as a thank you. So thank you. Cool. Let's move on here to 3981 North Weber, which is Northern Colorado Springs.
Yep.
So yeah, walk us through because I'm excited about all the projects.
Yeah.
This one, especially some of the financing and like you said, the more affordable rents, like it really, really tickled my fancy.
Yeah. So this is a really interesting deal. We've been working on this for a little while, and we're partnering with a company called Blue Truck Capital on this project. They're friends of ours, and they actually found the site. We decided to partner together after the fact. So really, a lot of credit to those guys for buying. I think we bought the dirt at like $5 a square foot, which is kind of crazy to think about. So a lot of credit out to those guys. And this is going to be a co-development with those guys, 50-50 co-development. Really smart guys. And we're essentially going through the HUD process right now. So this can be a HUD deal. And I think the reason, this really kind of hits upon HUD's, really kind of what their long-term vision is for what HUD is. And that's trying to make housing affordable. Sometimes they do things that are contrary to that, which we could talk about even in development they do, such as making everything union. Let's see how we can make the project more expensive. Let's make it union, which that makes no sense, but that's government for you. This is a HUD deal, 221 D4. We're through 2 of the first 3 phases on the project. It can be a little bit arduous to get through, and they've done a great job navigating, helping us navigate through that process. What the interesting thing about a HUD loan is it's a construction to perm that's 40. It's a 40-year loan. Essentially.
So say it again. So it's a construction to perm 40-year loan.
Yep.
Break that down because I have to have you repeat that to me the first time.
Yeah. Yep. So essentially when you bring these guys on, it's a 40-year loan. First 2 years are interest only, then it starts amortizing on a 40-year basis after that. It's the reason it's kind of intriguing is the economics of it are just a lot better than anything you're going to get in the open marketplace today, right? So you go do a loan right now for construction, you're probably at 57 to 62% now with interest rates coming down a little bit. You're looking at probably an interest rate somewhere depending on the project bank, all of those things, probably between 7.75 to 8.5, which has come down there for a while. It was 10, 11. So it's just that long-term investment strategy with it. What you have, right? So I think we're at 6.15% on this one right now. Maybe we're lower with interest rates coming down. I don't know. We have to kind of re-engage on this last process here, but it's just it's a great mechanism for developers. It's fully, through the first couple of years, there is a prepayment penalty, but it is transferable, on down the line. So I think there's just a lot of benefits to utilizing that program. What I would say, there is a little bit that you have to, that you give up, for doing, what I consider a really good structured loan. And that is, the reporting requirements are very extreme. So going forward, we'll have to do a lot of reporting, and there's certain, uh, requirements that your building have to meet every year through inspections and things like that, and you are required to fix them in a certain amount of time. Once that report comes back, it's an annual report. There's quarterly reporting that can be intensive. So that's kind of what that's what you're giving up or having to do in exchange for a loan like this. But
it sounds like for the amazing financing, it's worth the extra hoops, right?
It's worth the extra hoops on this one. Yeah. Yep. And you can't get a HUD loan everywhere, right? They have certain areas that they're targeting. They have certain product type that they're targeting. So this is not, you might ask, well, why don't you do this for South Logan? Well, there's a chance we might be able to get it for South Logan, but it's not a guarantee. We just thought the other one was a better fit because it's, really is kind of that middle missing, affordable, let's call it attainable housing, from a rent perspective. So we thought it was a really strong candidate for that.
Great. Again, we'll just flip through the deck pretty quick here. And again, we'll share it all after the webinar so we can download it and you can read the details. And so talk about this part of northern Colorado Springs, because I'm not super familiar with it.
Yeah.
Why do you like the location so much?
I like the location. It's an area of transition. And they, we're right in an area, they call it an area of influence to the South Nevada redevelopment plan. So they have a lot of dollars dedicated to South Nevada, which runs pretty close to the site here. That's one of the reasons I like this. So you're going to start seeing this area of, and when we say northern, it's not super north, like up by Academy and all that stuff.
Yeah.
Where you see a lot of development. This is kind of in between those two. It's a 3-minute drive to UCCS. UCCS is projected to be larger than have more students than Boulder in 10 years. They've got hundreds and hundreds of acres around their campus down there. To continue growing.
So they actually have room to build where Boulder has no room.
That's it, right?
Yeah.
So yeah, Boulder is landlocked now. So we think, they pretty much said they're going to keep growing down there. And we know that as of right now, there is no on-site housing for students. Everyone is in apartments around there. Very similar type thing where, all of the, your high 90s, 100% occupied. We're not, want to make it clear, this is not a student housing deal. We think we will get students that will live here.
Yeah.
And you know what? And you kind of tell from the area, the area, the site's dilapidated, right? It's an old baseball field that's been run down. Usually there's a broken camper parked somewhere around the site. So we think this is really taking what we consider a blighted site and turning it into a really great development, to be honest with you, at the end of the day. And I think the other reason I like this, Chris, in this location is it's a blue collar neighborhood. And so this is when you look at the pro forma, we're heavy 2s and 3s here. So we thought that made sense with the demographic of the neighborhood. Number one, we're going to see, I think, a lot more families than you would see in a downtown location, and with students.
Students have roommates.
Students have roommates, right? They're trying to keep their rent low. So we felt that was the best design. This is a 3-story garden walk-up, surface parked. So there's no structured parking here. Right, so we're really committed to keeping our costs down. At the end of the day. So that's that's really I think this is an AI generated rendering, so it does look similar to this, but this is not an exact,
not the official
this
one,
is not the exact this is not the exact rendering, but it's very close. It's a white and black building, 3 stories. So yeah, we just feel like this product type, meets the mark for the market down there. And, I think we're excited to bring something a little different to the portfolio as an offering. If you go to the rent page, I think our average rent is well below $2,000 for 2s and 3s. You start spreading that across a couple people, 2-3 people, that makes it's affordable.
Yeah.
So that's really kind of the focus here.
So you're anticipating about a total, almost $34 million so
project. Yep.
But I know, so the other thing I recall seeing on here, I know you got the amazing, HUD financing pipeline, but you're also getting like $1 million incentive from the city
Yeah.
or a group, right?
Yeah.
Which
So it's URA, it's an Urban Renewal Authority, and essentially, it's TIF dollars backed by bonds. And ultimately, at the end of the day, there's different agencies and things that have to sign off on it, but it's really a tool that the city uses to help make development more feasible at the end of the day. And we've actually have our application into those guys right now. So we'll know for sure kind of what those proceeds are going to look like in another, I would say by the end of the year, we'll know
okay.
what that looks like. We're pretty sure we can get something. And then obviously, not being a class A plus plus property that's asking for all these incentives to make the deal work. It's like, hey, like we're building something that is, extremely impactful in the community.
Oh,
But
it's so needed.
we could use your dollars to help help make this thing work. So that's that I think that's really important, and that's why I'm saying the city's just really behind a lot of the stuff, and really I think making the city a better place.
All right. And then moving through it, we got a couple months left, and we'll get through this pretty quick here. So
Yeah.
there's a 10-year pro forma you can
Yep.
download and look at.
Yep. And kind of back to that, back to that one really quickly, the 10-year pro forma.
Yeah.
You see, your cash on cash just kind of grows over time with this, right? You don't see that big pop from a refinance. That's because we're not refinancing. We have a 40-year loan. There is an opportunity. The cool thing about HUD, though, which we have not made the assumption in here, is you can actually do a secondary 221D4, as I understand it as well. So a secondary loan means, if the property is performing really, really well, we have the ability to, put a second loan on it basically and pull cash out of the project. So if that happens, you should see the cash on cash jump through the roof.
Oh, wow.
You'd be double digits very quickly. But we're not making that. We try to be, I know we are developers, so we have to be a little bit optimistic, but we try not to push the envelope too much and bring some conservative underwriting in here. So yeah, you can see kind of the plans. We have 11 different buildings here. 10-year hold. So we've got, and you can see in here we've got GP stuff, LP stuff. We try not to hide anything.
Yep.
So I'm sure we'll get into questions. I think we have time for maybe a few today, and then I know we have a Q&A followed up. But I think. I think we hit on the important stuff today.
Yeah.
Why combine these three together and the benefits of it. What does, each one brings a little something different to the table though, as well. And I think from a diversification standpoint, that's pretty cool. Cause it's not like, hey, I'm investing in 3 projects that are all class A plus in downtown Denver. Right.
Yeah.
It's diversification across the portfolio a little bit. So hopefully they all do really, really well. But in a case that one doesn't perform quite as well as maybe we had thought, hopefully you've got another one that outperforms and you end up kind of back at the mean.
All right. So we'll do a quick overview of investor returns, and we can hang on for a few questions on here. We kind of covered this beginning executive summary, and soon we'll have the follow-up with everything combined with legal docs for everyone to look at.
Yep.
But you can see here it's strong cash on cash, a very strong IRR over like a 10-year hold period. And then I like the equity multiple. I mean, hopefully around that 3x mark.
Yep. We hopefully be around 3x.
Which is phenomenal. So this is open to accredited investors only. So that means really 2 ways to qualify. Either income, $200,000 a year if you're single, $300K if you're a dual household, or $1 million in investable net worth. So it's open to accredited investors, and your CPA can fill out a form, or we have some third-party websites that can verify you as well if you don't have a CPA. But minimum check size is $50,000, and this can be funded through cash or a self-directed IRA or 401k. So if you have one, you can invest in here, or if you have an old IRA from a previous employer, we can send you some good resources and custodians help you roll over to a self-directed IRA, which allows you to invest in things that are not stocks and bonds, but real estate. Or if you're self-employed and you have a 401k, you can also roll that over or convert it to a self-directed 401k as well. So lots of options. If you guys want help on that, I've done all of those. So happy to kind of give you my experience. And we're looking to have it funded by November 22nd. So if you're interested in this, let us know the amount you're thinking. We'll just put you down to save the spot for you, because we do expect to fill out with the diversification and the more favorable economics on here. But if you tell us that, you're also not committing it. So let us
Yeah.
know. And hey, we understand you do your DD and figure out financing on your end.
So let's go back to that for just a quick
Yeah.
minute though too. Let's talk on OZs for maybe just a minute. We didn't talk about it on that slide.
I love it.
Oh, never mind.
Perfect.
All right.
So I'm gonna set you up, Adam. So can I do a 1031 exchange into this fund, Adam?
No.
Okay.
You cannot 1031 into this. There's a lot of requirements around 1031s, and it has to be kind of a like kind asset. So you can't sell at a value add deal and invest it into a development deal unless the development deal sits there for like 2 years. It's very, very challenging. So unfortunately, it's really hard for us to take that on at this point in time. Now once we're ready to go vertical, I think can be a little bit of a different story, but right now it's very hard. What we can look at though is we've done the math on it, and I know, Chris, this is something that you've looked at as well. Is there's these qualified opportunity zones, and what a qualified opportunity zone is essentially is it's a way for you to essentially create wealth, growth of your assets, essentially growth of your cash, without having to pay taxes on it. And we've done the math, and on a 10-year hold on something like this that hits, we'll call it 3x your money. It's actually more beneficial to be in an opportunity zone than it is a 1031. Because in a 1031, you are going to pay taxes at some point. That you are going to. Now it might not be you, it might be your trust down the road, or however that goes, but at some point in time you are. With this, you're essentially, you do have to pay taxes in 2026 on your gains. And this can be gains from anything. This can be gains from the sale of a company. This can be gains from the sale of stock. This can be gains from real estate. Kind of goes multiple different ways. But if you pay those gains, then essentially the next 10 years, and there are certain hurdles, it gets very nuanced in between, but essentially, for the next 10 years, you can let that grow. And in an opportunity zone, you have to let it sit 10 years in order to take full advantage of the taxes, the tax break there. That money grows tax-free over that entire time. So let's say after taxes, you put in $100,000, you put it in this fund, it grows to $500,000. Let's just say we grow it to $500,000 over the next 10 years. None of that gain is taxed.
Yeah. And so we'll go to more, because actually we got a 10 date with the CPA team once we're past the October 15th deadline, which we're really close to, which I'm excited about. But that sink in for a second. I am looking at selling a fourplex and probably rolling over a big chunk of it into a QOZ deal like Canopē.
And with that, I will say too, if that does happen, if we have QOZ investors that come in, there are certain ways we have to set up entities and things. So that would be an investment in an entity outside of, so essentially we'll probably have one entity that is an investor in all three of these projects. If you come in as a QOZ, you're not going to be a part of that entity. You have to be a part of a different entity, because we have to track it for tax purposes in a different way.
And it'll only be invested in the Canopē.
And it would only be in the Canopē project, because that's the only one that's a QOZ, which is a qualified opportunity zone.
And so we'll do more details on the QZ stuff, but that money is not have to be in there by the November 22nd timeline. There's a longer window for that, but we'll go into more details. It's more complex, but it's exciting because, as Adam was talking, hey, that goes from 100 to 500,000. When it comes to sell, guess what? You don't have to 1031 the money in anything, and you don't have to die to not pay taxes. The money comes to you, and it's tax free.
It's yours,
and you can do whatever you want with it then, which is really, really cool. So if you got any questions on here, I know a lot of people said great, thanks for the presentation. Please send the docs. We absolutely will. Question here from someone is, what makes your net worth in real estate investable? It's not just a $1 million, and this is going back to the accreditation verification. It's not just $1 million in real estate. It's just $1 million in general and investable assets. So basically everything that's not in your primary residence, For a loose example, say the $500,000 in equity, you have $400,000 in IRA, and then $100,000 in a bank account. Well, that's $1 million, and that meets that threshold. So I can send you more details on there afterwards. But it's all your assets combined outside your primary residence, cash, real estate, stocks, bonds, IRAs, wine, artwork, crypto. If you can get that valued anyway. But it's all in investable assets. So I know we're a couple months past here, and the last thing I will say, because I went through a lot of stuff and people want to dive in the details based on the comments, we have 2 dedicated question and answer Zoom calls scheduled for Friday, October 18th. So in exactly 1 week. And then Thursday, October 24th. So we'll get you all the materials out before. Please come join those.
Yep.
And if you can't make it, submit your questions before. We'll record it. We'll add it to the data room. And then we're also coordinating some potential site walk visits, or at the very least, some in person, so you can meet Adam and some of the rest of the team at a restaurant or your office.
Yep. Well, I think we're open to whatever everyone wants to do, but I do think getting on site and seeing it and the vision in the neighborhoods and things is helpful.
Yeah. Awesome, everyone. Thank you for coming out. We'll send you an email here soon with all the details. If for some reason you don't get it, feel free to email me or Adam, and we'll make sure you get the details. But Adam, thank you so much for your help on here. And then Ireland and Jules, who are sitting behind the camera right now, they did a lot of work to make sure we got this. We could herd all these cats and details. So big thank you to our teams. All right, everyone, enjoy the weekend, and we'll see you hopefully on next week's phone call. Bye-bye.